Welcome to the ASC 225 Income Statement Training Series from PNJ Group. In this first section, we are going to build your foundation, what the income statement is, why it matters so much, and the two formats you will see in practice. By the end, you will understand why the structure of this statement is not just an accounting choice but a communication tool that shapes how analysts, investors, and creditors see a business. By the end of this section, you will be able to define the income statement and identify the standards that govern how it is prepared. You will understand why seemingly small classification decisions, operating versus non-operating, continuing versus discontinued, can have a major effect on the numbers analysts care about. You will be able to name the core components that appear on every income statement, describe the two formats used in practice, and know which format PNJ Group recommends and why. Here is the first thing to get right. The income statement is not a snapshot. It is a film, not a photograph. It covers a period of time, a quarter, 6 months, or a full year. The balance sheet tells you where the company stands today. The income statement tells you what happened in between, and that period must be clearly disclosed in the heading of the statement. A seemingly small requirement, but one that prevents a lot of confusion about which results you are actually looking at. Several standards work together to define what must appear on the face of the income statement versus in the notes. ASC 220 governs how comprehensive income and other comprehensive income are presented. ASC 205 defines discontinued operations and requires them to be separated from continuing operations. ASC 260 governs earnings per share disclosure for public entities. And ASC 740 governs how total income tax expense is allocated across different parts of the statement. You will become very familiar with all of these throughout this course. Here is the key thing to understand early. The income statement is not just a compliance document. It is the primary source of information about an entity's performance. And the way you classify items on that statement directly affects the metrics everyone uses to evaluate the business. Put something in the wrong bucket and you have changed the operating margin, the EBIT, the earnings per share, numbers that drive stock prices, credit decisions, and executive bonuses. This is why classification is not a detail. It is a judgment that requires careful thought every single period. Every income statement, regardless of format, contains the same fundamental building blocks. Revenues sit at the top, the inflows from the entity's central operations, recognized under ASC 606. Below that comes cost of goods sold, the direct costs of producing what was sold. Subtracting those gives you gross profit, your first measure of efficiency. Then come operating expenses, the costs of running the business that are not directly tied to individual units sold. Below the operating line you find non-operating items, income tax expense, and finally net income at the bottom. The single-step format is exactly what it sounds like: one step. You add up all revenues and gains, you add up all expenses and losses, and you subtract. Done. It is clean and simple. The problem is that it gives you almost no analytical insight. You cannot see the gross margin. You cannot see what the company earned from its core operations before financing and tax effects. For a small private company keeping things simple, it might be fine. For any engagement where analysts will be reading the results, it falls short. The multi-step format is the standard for serious financial reporting. It gives you 3 key subtotals: gross profit, operating income, and income before taxes, each of which tells you something different about how the business is performing. Gross profit measures pricing power and production efficiency. Operating income shows you the profitability of the core business before financing and tax. And because it separates operating items from non-operating items, it lets you compare one company's operating performance to another's, even if they have very different capital structures. This is why virtually all public companies use the multi-step format. Look at these two formats side by side. Both arrive at the same net income of $275,000, but the single-step version gives you almost no information about how you got there. The multi-step version tells a story. The company generated a $600,000 gross profit, spent $345,000 on operating expenses to arrive at operating income of $255,000, then added small net non-operating items to reach income before taxes. Same numbers, completely different analytical picture. This is why the multi-step format is the professional standard, and the one PNJ Group recommends for all engagement work. PNJ Group's position is clear. Use the multi-step format for all engagement work. This is not just a preference. ASC 220 requires that operating income either be displayed on the face of the income statement or disclosed in the notes. For SEC registrants, there is essentially no choice. And even when a client uses a single-step format internally, when it comes to external reporting, you should be recommending the multi-step. If you encounter a situation where this is unclear or contested, that is a team lead conversation. Let us lock in the key points from this section. The income statement covers a period of time, not a single date. The way you classify items on it directly affects operating margin, EBIT, EPS, and other metrics that drive real decisions. The governing standards are a SC 220, a SC 20520, a SC 260, and a SC 740-20. The two formats, single-step and multi-step, arrive at the same net income, but the multi-step tells a far richer story. And PNJ Group's standard is the multi-step format on all engagements. Next, we move into what actually fills the top half of that multi-step statement, revenue and cost of goods sold. Thank you for completing this section on income statement fundamentals and formats.